Imagine finding your dream home. It's beautiful, it's spacious, it's everything you have ever wanted. But when you sit down with the lender, they drop a term you may have never heard before: jumbo mortgage. And here's the thing: jumbo mortgage rates do not always work the way you think they do. In fact, they can be surprisingly tricky. Sometimes they are higher than regular rates. Sometimes they are lower. And what really decides that can completely change how much you pay over the years. By the end of this video, you will know exactly how jumbo mortgage rates work, what makes them move up or down, and how to make them work in your favor. So, let's break it down step by step. Number 1. What is a jumbo mortgage really? Think of a jumbo mortgage like buying the extra large size of a loan. Regular mortgages have a limit set by something called the conforming loan limit. In most parts of the USA, that limit is around $766,000 in 2024. If you need to borrow more than that, you step into jumbo loan territory. Example: if your dream home costs $900,000 and you are putting $100,000 down, you will need to borrow $800,000. That's above the conforming limit, so your loan becomes a jumbo mortgage. This matters because jumbo loans are not backed by Fannie Mae or Freddie Mac, the big government-backed agencies. That means lenders take on more risk, and that risk affects your rate. Number 2. Why jumbo mortgage rates can be higher or lower than normal loans. Here is where things get interesting. You might think bigger loan equals bigger rate, but that's not always true. Sometimes, jumbo rates are actually lower than conforming rates. Why? It often depends on the lender's appetite for big loans, the type of buyers in the market, and overall economic conditions. For example, in a strong housing market with wealthy buyers, banks may offer attractive jumbo rates to bring in high-income customers. On the flip side, during uncertain economic times, they may raise jumbo rates to protect themselves. So it's not just about the loan size. It's about the risk and the market mood. Number 3. The role of your credit score. Your credit score is like your financial reputation. For jumbo loans, lenders care about it even more. With such large amounts, they want to see proof that you can handle debt responsibly. Example: someone with a credit score of 780 might get a jumbo rate of 6%, while someone with a score of 680 might get offered 6.75% on the same day from the same lender. That difference can add up to tens of thousands of dollars over the life of the loan. Number 4. The impact of your down payment. Jumbo loans usually require a bigger down payment than regular loans. While some conforming loans let you put down as little as 3%, jumbo lenders often want at least 10% to 20%. Why? Because the more money you put in up front, the less risk for the lender, and less risk can mean a better rate. Example: if you buy an $850,000 home and put 20% down, you may get a lower rate than someone who puts 10% down, even if you both borrow from the same bank. Number 5. Debt-to-income ratio matters more than you think. Lenders do not just look at your income. They look at how much of it is already promised to other debts. This is called your debt-to-income ratio, or DTI. For jumbo loans, many lenders prefer your DTI to be 43% or lower, sometimes even stricter. Example: if you earn $10,000 a month, your total debt payments, including the new mortgage, should be no more than $4,300. Go over that, and not only could your rate go up, your loan could be denied entirely. Number 6. How the property type can change your rate. Buying a single-family home that you will live in. That is usually the easiest type of property to finance with a jumbo loan. But if it is a vacation home or an investment property, your rate could be higher. Why? Because lenders see those as riskier. Example: if the economy slows down, people are more likely to sell their vacation home than their main home. That risk gets priced into your rate. Number 7. Fixed rate versus adjustable rate jumbo loans. With a fixed rate jumbo mortgage, your interest rate stays the same for the entire term. With an adjustable rate jumbo mortgage, your initial rate is fixed for a set period, say 5 years, and then it can adjust every year after that. Adjustable rates often start lower than fixed rates, which can be tempting. Example: you might see a fixed jumbo at 6.25% and a 5-year adjustable at 5.75%. But remember, after the fixed period, the adjustable rate could rise, sometimes a lot. Choosing between them is about balancing short-term savings with long-term stability. Number 8. How economic trends push rates up or down. Jumbo mortgage rates move with the broader economy. If inflation is high, rates tend to rise. If the economy slows down, rates often fall. For example, during the 2020 pandemic slowdown, jumbo rates dropped along with other mortgage rates, making big loans cheaper for a time. So, timing your purchase when rates are lower can save you a huge amount over the years. Number 9. The hidden cost you might not see at first. With jumbo loans, it is not just the interest rate you need to watch. Some lenders charge higher closing costs or special fees for these larger loans. For example, you might see an attractive 5.9% rate, but when you look at the loan estimate, there is a jumbo loan origination fee of $1,500. Always compare the annual percentage rate, or APR, which includes those fees, not just the base interest rate. Number 10. Why shopping around is non-negotiable. Because jumbo loans are not standardized like conforming loans, rates can vary wildly between lenders. Example, one bank may offer you 6.1%, while another offers 5.8%. Even if you give both the same information, on a loan of $800,000, that difference can mean paying over $50,000 more or less over the life of the loan. Get quotes from at least 3 lenders, and do it within the same 2-week period so it only counts as one credit inquiry. Number 11. How relationship banking can help you. Some banks give better jumbo rates to customers who have other accounts with them. If you have a large savings account, investment account, or even your business accounts with the bank, they may see you as more valuable. Example, if you keep $250,000 or more in deposits with a certain bank, they might offer a rate that is 0.25% lower than their standard jumbo rate. That small difference can mean big savings. Number 12. The pre-approval advantage. Getting pre-approved before you shop for a home is always smart, but for jumbo loans, it is essential. It tells sellers you are serious, and it helps you lock in a rate early, especially if rates are rising. Example, if you get pre-approved at 6% and rates jump to 6.4% before you close, that pre-approval could save you thousands. Number 13. Strategies to get a better jumbo rate. Boost your credit score by paying down debts and making all payments on time. Increase your down payment to reduce the lender's risk. Shop multiple lenders, including local banks, credit unions, and online lenders. Consider paying points up front to lower your rate if you plan to stay in the home long term. Example, paying 1 point, which equals to 1% of the loan amount, could lower your rate by 0.25%. On an $800,000 loan, that is $8,000 up front, but it could save you more over time. Number 14. The big mistake to avoid. Do not focus only on the monthly payment. Look at the total cost of the loan over its life. Example, a slightly lower payment with a higher rate could cost you more in the long run than a slightly higher payment with a lower rate. Always run the numbers both ways. Number 15. How loan term length affects your rate. The length of your jumbo mortgage term can make a big difference in the rate you get. Shorter terms, like 15 years, often have lower rates than longer terms, like 30 years. Example, a 15-year jumbo might come with a rate of 5.6%, while the same lender offers 6.2% for a 30-year term. While the monthly payment will be higher for the shorter term, you could save hundreds of thousands in interest over the life of the loan. Number 16. Why cash reserves matter. Lenders want to see that you have a financial cushion after closing. For jumbo loans, this can mean showing you have 6 months to a year's worth of mortgage payments saved. Example, if your jumbo payment is $5,000 a month, you might need to show $30,000 to $60,000 in reserves. This reassures the lender that you can keep paying even if your income drops temporarily, and it can help you get a better rate. Number 17. The influence of location. Where your property is located can influence your jumbo rate. Some markets are considered more stable and less risky for lenders. Example, a jumbo loan for a home in a high-demand city with a strong job market may get a better rate than a similar loan in a rural area with declining population. Number 18. Rate lock timing. Mortgage rates can change daily, and with jumbo loans, small changes can mean big money. If you find a good rate, you can pay to lock it in for a set period, often 30 to 60 days. Example, Locking in a rate at 5.9% today could protect you if rates climb to 6.3% before you close. Number 19. The role of private mortgage insurance. Most jumbo loans require at least 20% down to avoid private mortgage insurance, or PMI. If you put down less than that, the lender may require PMI, which adds to your monthly cost. Example, PMI on an $800,000 jumbo loan could be over $300 a month, making the loan more expensive even if the interest rate looks attractive. Number 20. Negotiating closing costs. Even on jumbo loans, some costs are negotiable. Ask the lender if they can waive or reduce certain fees in exchange for a slightly higher rate or for moving other accounts to their bank. Example, a lender might remove a $1,000 underwriting fee if you agree to keep a large deposit account with them. Number 21. Watch out for prepayment penalties. Some jumbo loans include penalties if you pay them off early. This could happen if you sell your home or refinance within the first few years. Example, a prepayment penalty of 2% on an $800,000 loan means a $16,000 charge. Always ask if your loan has one before signing. Number 22. How loan-to-value ratio plays a role. Your loan-to-value ratio, or LTV, is the size of your loan compared to the value of your home. Lower LTV means less risk for the lender, which can mean a better rate. Example, borrowing $700,000 on an $875,000 home gives you an LTV of 80%. If you instead borrow $600,000, your LTV drops to around 69%, and you may get rewarded with a lower rate. Number 23. Using jumbo loans for construction. Some jumbo loans are designed for building a custom home. These construction-to-permanent loans let you borrow during the building phase and then switch to a regular jumbo mortgage when the home is finished. Rates for these can be slightly higher because of the extra risk during construction, but they save you from getting two separate loans. Number 24. Impact of your employment history. Stable, consistent income makes lenders more comfortable offering better rates. Example, someone who has worked at the same company for 8 years may get a better offer than someone who has changed jobs 3 times in 2 years, even if their income is the same. For self-employed borrowers, expect to provide extra documentation like 2 years of tax returns and detailed financial statements. Number 25. How global events can shake jumbo rates. Sometimes, jumbo rates move because of things happening halfway around the world. Major geopolitical events, global market crashes, or international banking issues can influence USA mortgage rates. Example, if global investors start moving their money into safer USA bonds, mortgage rates, including jumbo rates, can drop temporarily. Number 26. Why not all lenders offer jumbo loans? Some lenders simply do not want to take on jumbo loan risk. This means you have fewer options, but it also means those who do offer them may specialize in them and give better deals. Working with a lender experienced in jumbo mortgages can mean faster approvals and more flexible terms. Number 27. Combining 2 loans instead of one jumbo. Some borrowers avoid a jumbo loan by taking out a conforming loan up to the limit and a smaller second loan for the rest. This is called a piggyback loan. Example, instead of one $800,000 jumbo loan, you take a $766,000 conforming loan and a $34,000 second mortgage. Sometimes, this setup can result in a lower overall cost, but you have to compare carefully. Jumbo mortgages might sound intimidating, but they are just another tool. And like any tool, they work best when you know how to use them. Now you know what drives jumbo mortgage rates, how to influence them, and how to avoid costly mistakes. But here is the real question. If you were offered a jumbo loan with a slightly higher rate but better overall terms, would you take it? I would love to know your thoughts in the comments.